Welcome back. In the previous video, you learned the formula for growing perpetuities. In this video, we will use it in two applications in which this formula is very prominent too. The first is the Gordon Dividend Growth Model. The second is the Implied Cost of Capital. Lots of words, but you will see in a moment what this means. Incidentally, the CFA Institute on its exam loves to torture its students with questions about these two models. So it is very relevant. So here is the Gordon Dividend Growth Model. What do you think should be the share price of a firm that pays dividends of $1 per year, whose dividends grow by 4% every year, which will continue to grow forever, to do so forever, and whose discount rate is 12% per year? This is called the Gordon Dividend Growth Model. It's literally just the growing perpetuity formula applied to dividends. Nothing else. Dividends replace cash flows, that's it. So you already know this model. What should be the value of a firm whose dividends are $1 per year, beginning next year, which grows by 4% per year, for which the appropriate discount rate is 12%, just as I asked before?
Please pause this video now, answer the question on a piece of paper, and then continue.
It's the growing perpetuity formula. The value is $1 divided by 8%. That's $12.50. Of course, in the real world, the key problem is that we don't know whether dividends will grow by 4% forever. If it only were this easy. Please, don't take this model too seriously. Past dividends are very often not reflective of future dividends. The dividend growth assumption is the big if for the Gordon Dividend Growth Model. And in a sense, the whole model is absurd. The logic is absurd. So imagine a firm that pays no dividends for a few years in order to accelerate its growth. So instead of the dividends, it invests the money. So it has zero dividends this year, next year, for a few years. This doesn't mean the firm has no value. In fact, if anything, the opposite. Hopefully it has a lot more value, which is why they reinvest the money rather than pay dividends. And by the way, also don't take the timing too seriously here. I know the growing perpetuity formula says it has to be the exact number. On the midterm, on the CFA exam, yes, you worry about timing. In the real world, the rest of the model is so absurd. Don't worry about this one little absurd hook. Now, you can turn the formula around for basic insight about dividend price ratios and dividend multiples. So if you take the formula, it would be the dividend divided by prices should be R minus G. Or the price dividend multiple, you just switch numerator and denominator, that should be 1 divided by R minus G. So firms with higher growth rates of dividends, G, and lower discount rates, R, should have higher multiples. So incidentally, let's do this with earnings instead of dividends, even though there isn't such a thing as the Gordon earnings growth model. For example, look up the price-earnings ratio of Alphabet, the parent company of Google. If its cost of capital right now were about 8% per year, what would you expect its earnings to grow?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, in early 2025, if you go to the website, the EP ratio was about 24, which, if you invert it, is about 4.2%. So for Google, we would expect this to be 0.08 minus G. Solve this, turn this around, and the answer is Google is priced as if its earnings were growing by about 3.8% forever. That's modestly faster than the long-term inflation rate. And the answer is it's already very big, so it's not a real growth company anymore. It's a tech company, all right, but not a growth company. It already owns most of the advertising market. So just maintaining it is going to be quite a challenge. And maybe some of the artificial intelligence companies are going to offer different kinds of search engines. In fact, that's probably the biggest threat to Google right now, and the most exciting application of artificial intelligence for making money. Now, it makes sense to believe that firms with unusually high dividend price ratios should have either lower future dividend growth to get back in line, so the dividends no longer grow so much, or they should have higher future expected rates of returns. So if the dividend payments are going to be really, really high for a long, long time, it looks like you're going to make a lot of money here. So here are some examples. If a firm has a dividend yield of 50%, unless the dividend yield was temporary, it could earn a huge rate of return just by buying and holding the stock. Or alternatively, if a firm has a dividend yield of only 1% and it ain't growing, why would anyone ever want to buy it at this higher price? If the price fell, the dividend price ratio would go up again. This is what I already mentioned. Firms can shift dividends. So what a firm does not pay out in dividends today will make more hay, well, more dividends tomorrow. So that's one of the reasons why the logic of this whole model is sort of dubious. An improvement uses the plowback ratio. So if the firm doesn't pay dividends, takes the money, reinvests it, it plows back more of its money into the firm. And there are some formula variations that try to take advantage of it. But frankly, it's still just lipstick on a pig. I also prefer earnings over dividends in this formula because earnings are a little bit more difficult to shift around. But I wouldn't take this too seriously either. Don't trust the Gordon Dividend Growth Model in any form, please. Our second application is the implied cost of capital. It's again just the growing perpetuity formula, but this time we will turn it around to solve for the rate of return rather than the value or the dividend price ratio today. So, what is the cost of capital for a firm that pays a dividend yield of 5% per year today if its dividends are priced as if they are expected to grow at a rate of 3% per year forever?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, we just take the formula, P equals D divided by R minus G. That's the growing perpetuity formula, just with D instead of C. We solve it for R. That turns out to be the growth rate of dividends plus the dividend price ratio. This particular example, we have given that the growth ratio is 3%, the dividend price ratio is 5%. So it's as if it's priced as if its cost of capital, its discount rate was about 8%. Again, like the Gordon Dividend Growth Model, it's still just a Hail Mary model, by which I mean you have to pray a lot for this to be right. It's really a very inaccurate model. It gives you some concept, some over the envelope way of thinking, but don't take it too seriously. It's called the Implied Cost of Capital, and it's abbreviated ICC. It's thought of as the expected rate of return implied in prices, or price multiples for that matter. It's sometimes worked with earnings, sometimes with dividends. A higher stock price P today implies a lower implied expected rate of return, cost of capital, discount rate, at which the firm is working with the capital that it has gotten from its investors. Here is the most interesting use of the implied cost of capital. Is the stock market currently too high, too low, or priced about right? If you believe the model. So we're going to use the stock market, S&P 500. That's a stock market index. It's often called just the market. Of course, there's many other financial markets, not just the stock market, and there's certainly also many other stocks, not just the S&P 500. But most people just say, how did the stock market do today? How did the S&P 500 do today? We will work up an implied cost of capital for the S&P 500 using its dividend price ratio as of early 2025. Look it up. In history, around this time, the dividend price ratio of the S&P 500 was about 1.5% per year. It turns out that the second input that we need, the dividend growth rate, tended to be extremely variable year by year. Over the last 100 years or so, depending on how you average it, whether you pull in outliers or other things, it probably was about 4.5%, 5% per year. And this is of course nominal because unless I specify otherwise, all quantities are nominal. Thus, if you take the formula, the implied cost of capital, the expected rate of return, seems to be about the dividend price ratio plus the growth rate. So we're talking about 6% per year, maybe 7%, but order of magnitude, this is roughly what this model says. For comparison, around the same time, the yield on safe 30-year long-term Treasury bonds, which you can look up on the US Department of the Treasury website, was about 4.8% per year. Both the payoffs on stocks and the payoffs on Treasury bonds, especially 30-year Treasury bonds, can be very long-term payoff assets. So they have flows for a very long time. So as far as term is concerned, they're about the same. It means that the risky stock market gave you about 6%, the risk-free one about 4.5%. The difference between the two is about 1.5%. This is called the equity premium. It's among the most important numbers in finance. Historically, it was about 6 to 8% per year. That's a huge number. The 1.5% per year that we see standing at the moment is much, much below than what it was on average in the past. We can also do this calculation with earnings instead of dividends, or dividends instead of earnings. It's really the same thing. What is the current PE ratio of the S&P 500?
Please pause this video now, answer the question on a piece of paper, and then continue.
Many financial websites. When I do this, I see that the PE ratio was about 30. If I invert this, it means that my earnings yield was about 3%. What's the approximate earnings growth for the S&P 500? Well, this was highly variable over the years. If you Google the history, you will see some of those numbers. I will also show you a graph in a moment. Long term, over the last 150 years or so, it averaged about 3% above inflation for earnings. So maybe 5 to 6% at the moment because we have an inflation rate of about 2 to 3%. And if you look at growth rate of earnings from one period to the next, this looks almost like normally distributed random variables, IID draws, and it's very, very noisy. So I went back and I calculated my own number, and my own number suggests from about 1926, 1871, a number of about 4% per year with a standard deviation of 30%, properly taking care of outliers. So here's my graph, here's what I came up with. And if you look at this, it's all over. What you had the previous year doesn't tell you much about what you will have the next year. It's very highly unpredictable. And of course, in the formula, I need a good number for the growth rate of earnings year to year. But I really don't have a great number because this is so darn noisy. But if I presume that history is a good guide as to the growth rate of earnings, what I should get 4 to 5% per year, what is the earnings-based implied cost of capital for the S&P 500? And remember, if you go back, we had about a 3% earnings yield.
Please pause this video now, answer the question on a piece of paper, and then continue.
So in early 2025, these numbers suggest around a rate of return of 7 to 8% per year. Go back, compare this to the long-term Treasury again, just like I did before, and you get the implied equity premium, not just the implied rate of return on the stock market.
Please pause this video now, answer the question on a piece of paper, and then continue.
If the implied cost of capital for the stock market is 8%, and the long-term risk-free rate is about 4.5%, then the implied equity premium is about 3.5% per year. Now, I beg you, don't believe this to be the gospel. It's an interesting, reasonable argument providing a good hint. But the model that we know what the growth rate of earnings is going to be and our estimate about these inputs are just too tenuous to put much faith into it. So these are great conceptual models, but the real world is a lot more complex than this. People who tried to use this model in the past to time the stock market didn't do that well at all. The stock market, at least over the last 30, 40 years, has traditionally had much higher average rates of return than what these models have always implied, which is of course also the reason why the stock market is so high today. It went up quite a lot more than what we ever believed it should go up based on its earnings price multiples and its growth rate of earnings. So, is the history now indicative of higher future stock market returns? By history, I mean that it went up, or lower future stock market rates of returns? You'll have to wait later for the course to give you some better answer to these questions, but suffice it to say for now, it's not an easy question to answer. Now, before we get to guessing where the stock market is going to go, we have to cover a lot of other important topics first. Our next subject is how loans work. See you soon. Bis bald. I'm sorry about all the perpetual motion jokes.
Why?
I just can't stop.
I can.